What's really going to happen to our property markets? Are they really going to crash like so many economists and market commentators are suggesting? Recently, I read a headline suggesting that the low unemployment figures are going to be the final knockout blow for our housing market because the Reserve Bank is going to keep rising interest rates. Now, I agree the Reserve Bank is going to keep ramping up interest rates, and this will further stunt consumer confidence because, of course, that's what it's intended to do. And yes, property values will fall, in some locations more than others. But how much will they fall and how worried should you be? That's what leading independent financial advisor Stuart Wemyss and I discuss in today's podcast. Now, just to make things clear, we're not internal optimists, and I believe that we are going to be offering you a realistic view of the risks ahead, as well as some of the supporting fundamentals. So I hope at the end of today's show you're going to be able to sleep a little bit better. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Are we heading for the biggest property crash in modern history? Is it just around the corner? Well, according to many economists, including those from the big four banks, we're heading for a housing crash and the value of your home could drop 10, 15 or even 20%. And it could even be a 30% fall according to one respected economy. So are we really in a property bubble that's about to burst? That's what I'm going to discuss in my monthly chat with leading independent financial advisor Stuart Wemyss, founder of ProSolution Private Clients. Hi, Stuart.
Hey, Michael. Great to be with you again.
Well, I bet you're reading the same headlines I am.
Of course, and rolling my eyes probably like you are.
Well, we've been around the block a few times, so let's start with the obvious question. Are we in a bubble? And what's the difference between a boom and a bubble?
So to my mind, the difference is how, when you look at historic growth rates, how far above are they beyond long-term growth rates?
I like the way you think, Stuart, because you base it on facts and evidence.
Yeah, that's right. The problem is that we don't really have a good long-term horizon, like as human beings. Like we find it difficult to conceptualize numbers over long periods of time. And also we get sucked into, unfortunately, a lot of short-term rhetoric. I mean, mostly because that's what the sort of rhetoric is on the market. In terms of media and so forth. So it's always good to sort of, zoom out and take a longer term view. So, if long-term average returns are, say, 8% in terms of capital growth rates for median house prices, in most capital cities, they're around about that. Then if our growth has been, say, 16% over the last 10 years, that to me starts to feel like a bubble. Whereas if our growth rate has still been only close to 8% or even maybe 9% over the last 10 years, that's probably a boom. So it's really how far above long-term growth rates. Now that can happen in two ways. It can happen because there's an extended period of higher than average growth, and probably the best market I could point to for that would be the S&P 500, so the stock index in the US. Returns prior to this year, the start of this year, were compounding 15% per annum over the last 10 years, whereas long-term returns in that market are closer to 10. So you've had, sustained period of above average performance. So it can creep up on you. And I think that's then creates a bit of a bubble. And then, or you look at Bitcoin, for example, if you get a 1,000% return in, 2 or 3 years, well, clearly, that certainly represents a bubble.
Well, it's usually characterized by a rapid rise of values or prices, I guess, rather than values that aren't always relevant to the underlying fundamentals. And in my mind, if it's owner-occupiers that have driven the last property price growth, the once-in-a-generation boom that we did have in 2020, 2021, that's less likely to be a bubble because people aren't buying them speculatively compared to the speculative investment that occurred in the mining towns, or even if you just go back to 2016-17, when 50% of people buying apartments in Sydney were investors, and often overseas investors who didn't understand the fundamentals.
It's a very good point, Michael, and a critical point that I think most commentators and particularly economists ignore. Because when we go and buy a home, or we make a decision to upgrade our home or buy a first home or whatever it is, but if it's a property that we're occupying, it's a completely different thought process than when we go to make an investment, whether that's an investment property or an investment on the share market and so forth. So, we can apply a set of logic to investment making decision and then draw conclusions from that depending on, what the market is doing and what the results are. And I'm completely fine with that. But when we go and make a decision to buy a home or even upgrade our home, what we're really doing is we're not making a value-based decision, like I think this asset class is attractive because of its future growth prospects. What we're really doing is making an affordability decision. I want to live in this location. I want more land. I want more accommodation. How much is it going to cost me to afford that? And can I afford that over a longer period of time? And as long as I can tick the boxes and say, yes, it's affordable to me, then it's more of a lifestyle. Beyond that, it's more of a lifestyle decision than the reason to make that acquisition. And so if then values change subsequent to me purchasing, does that then change the rationale of the original decision making? I bought because I wanted that location, I wanted that size. So really value doesn't really play into it. It's more about affordability.
Sure. So owner-occupier-led booms, like we've recently experienced, they tend to slow down. And when demand decreases, because a lot of pent-up demand has been taken up, and when affordability issues start to creep in, as has obviously happened, particularly in Sydney and Melbourne, property values don't crash. So let me put my thoughts of what causes a crash, or what has to happen for a crash to occur, as is being suggested by these economists. People have to sell, and there's nobody there to buy the property, Stuart, which means that they've got to give it away at a price substantially below what they were hoping for, and the value to drop 20, 30%, as some people are suggesting. But at the moment, there are no forced sellers. So home buyers, as you say, okay, I'm actually going to stay in my home. Some investors are going to get caught out. Some investors do sell up, and they did over the last couple of years, which makes no sense to me because their properties performed well. And some are going to get cold feet, get nervous and sell up. But there's no forced sellers at the moment, are there?
No, definitely not. And I think then if we have a look back at what drove the market during 2020 and 2021, these years are certainly a mouthful to say, aren't they? But what drove the market over that period of time is higher income earners, because they were able to preserve their income, that their occupations lent themselves to working from home, that their spending was reduced because they were locked inside their homes. Thank you very much. And they were in a great position, great cash flow position, and interest rates were incredibly low. So it made them really sort of sit back. They're spending more time at home, sit back and reflect, hey, we might need that extra bedroom so that we can work from home and so forth. Now, these guys, this cohort, okay, we talk about rising interest rates and particularly rising inflation, which in real terms, anyone that's been to the supermarket is much higher than what the CPI reading will suggest. Certainly these things bite, and they might have an impact on discretionary spending here and there, but it's not going to have any impact on affordability in terms of mortgage affordability for the people that upgraded during that period of time, because they are mostly higher income earners and they have a greater level of surplus cash flow to absorb the higher prices of goods. Not perpetually, not forever, of course, but I don't think anyone's suggesting that these higher prices will persist for years on end.
Well, recently the Assistant Governor of the Reserve Bank came out and showed some great graphs that showed that debt is in general in the hands of people who can afford it. So you're right, this was recently a cycle of upgraders, people upgrading, tenants upgrading to become first home buyers, people upgrading to get bigger accommodation, having that Zoom room, or moving to sea change or tree change. And those circumstances haven't changed. So people aren't going to sell up However, some investors may, but that's part of the reason I agree with you that I don't think we're in a bubble. Boy, did we have a boom, yes. And is it going to fizzle out? Yes. And it tends to be led by the upper end of the market, like we just mentioned, and it's now the upper end, the more affluent suburbs that are suffering a bit with prices. I guess you don't need your $15 million trophy home when your $12 million home works well enough, Stuart. That doesn't mean that the value of every home goes down. It's a much thinner market there. So if you're looking at median prices, yeah, the big price properties aren't selling, but that doesn't mean every property's dropped in value 10, 15, 20%.
That's right. And let's take a longer term view on these things, Michael. So I think the last boom was caused by really two main factors. Firstly, a bit of mean reversion, making up, particularly in Melbourne and Sydney, for, the market between 2017 and 2019, prices actually fell in terms of median house prices. So there's a bit of mean reversion in there. And there's no doubt there was a bit of what I might call FOMO premium. A situation where because of COVID and low interest rates, people thought, oh, hang on, property's going to go nuts here. I better get into the market and I better buy one tomorrow. And they were willing to overpay. I don't think there's any doubt during that period of time, the last couple of years, certainly people overpaid to buy property. So these two things sort of conspired to create, above average growth over the last couple of years. But if we zoom out and have a look at 5-year growth, say across Melbourne, Sydney, Brisbane, Melbourne and Sydney underperformed about 6.5% in terms of capital growth over that period of time. And remember, the long-term median is 8%. Brisbane outperforms only slightly, 8.5%. But if you look at 10-year growth for Brisbane, it's only 6%. So clearly Brisbane's making up. And if you look at 15-year growth for Brisbane, it's only 5.4%. So clearly Brisbane had some making up to do. Again, if you look at 10 and 15-year growth across both those three markets, they're all under the long-term average growth, except for Sydney. Over 10 years, it's done 9.5, so it's slightly above that long-term growth, but under in it from a 15-year period. So when you have a look at, okay, you say, yes, the last 2 years, extraordinary growth, it's a boom, etc. Well, I would say, yeah, there's been a bit of a boom there because of the FOMO premium, but I would say mostly it's mean reversion. Mostly it's just really making up for other periods in different, it's different in different markets, but making up for periods of time where there's been less growth, or in Melbourne and Sydney between 2017 and 2019, negative growth.
Yeah. So what you're saying is the markets haven't really gotten that much ahead of themselves. But there are people out there talking about mortgage stress. There are a couple of those property pessimists that have huge followings that are talking about how many suburbs are in mortgage stress. Now, you have a very holistic approach to wealth with your business at Pro Solution Private Clients, and one of the divisions is as finance strategist. So what's your definition of mortgage stress? Or maybe we should start with what the official sort of definition is.
Look, I don't know what the definition...
There isn't one, I guess, is there?
Well, maybe there's not. No, I'd imagine there's not. I mean, how do you measure that as well? And where are you getting your data? And how reliable is that data? As an analogy or an example, there's some data that there's no relationship between income in a suburb and its capital growth. I think, well, there might be no relationship in the data, probably because the data's wrong, not because there's no actual relationship, and I think then you've got to look at income and wealth. But clearly, if you've got more income, of course, there's going to be more growth. But anyway, so the first thing is, what data are they looking at? What definitions are they using and so forth? Look, Michael, I think during a period of time where inflation is really high and interest rates are rising, and lower income earners really certainly did wear the burden of COVID, I think the lower level of income earners are probably certainly suffering, are probably really could be struggling. That said, interest rates are still ridiculously low. And also, they're not the ones that really led the boom, as we've talked about. So it's probably likely that their debt levels haven't changed all that much over that period of time. But at a macro level, they're only a very small part of the market. in terms of total borrowings and the market and those sorts of things. And also, they're not living it's very unlikely they're living in investment grade locations. So I'm not even, as an investor, I'm not even particularly that interested from an investment perspective in those sorts of properties. So to say that there's mortgage stress at a macro level, when interest rates are well below the long-term mean, and even if interest rates or the cash rate rises above 3%, they're still well below the long-term mean. And to say in that scenario that there's going to be mortgage stress is ridiculous. But of course, as I said, there's going to be segments or cohorts that are going to be experiencing a lot more stress than others. But at a macro level, and particularly for the people that have driven the property boom over the last couple of years, no, I don't. I disbelieve it.
Well, some people are suggesting mortgage stress is when you spend more than 30% of your income on your mortgage payment. And I can accept that if that's the case, yes, people are in mortgage stress. But does that actually mean that that's a correct definition? Because your income is different to my income is different to a blue-collar worker's income. And it's not a judge of people, but their levels of potential stress or buffers is going to be different. I think a real-world view of mortgage stress is, are people keeping up with their loan repayments? Are they ahead or are they behind? And there are regular reports of this because our regulators want to make sure our banking system is stable. And there are very few loan defaults at the moment. And only recently, Matt Comben, the CEO of the CBA Bank, came out and said that on average, 75% of the biggest home mortgage lenders' books, the borrowers are on average 2 years in advance on their mortgage repayments. So apart from what's in their offset accounts, people have got significant buffers to see them through.
Let's not forget, it's almost been like a free financial kick. COVID has to a lot of people because interest rates have been really low and incomes, they've maintained their incomes. If you weren't working in hospitality or tourism or, one of those categories, then you've maintained your income through that period of time. And actually, what you've probably done is, what we can see in the data, they've either accumulated money in offset account or paid down their loan. So, of course, they're miles ahead. I would say mortgage stress is obviously if you're struggling to make repayments on time, clearly. Now, you can use rules of thumb like 6 times income in terms of your total borrowings or 30% of total income. And those rules of thumb can be useful or handy, but they don't apply to everyone equally. And so really, I think it comes down to the correct measure would be really cash flow. The amount of income coming in and the expenses and what I'm spending, as long as I've got a surplus and a relatively healthy surplus to afford higher repayments, I'm not in mortgage stress.
Sure. And some people are going to end up having a bit of a more difficult budget moving forward because mortgage rates are going to go up. But we've spoken before that about 50% of homeowners don't have a loan at all, and others have got fixed rate mortgages, which eventually are going to come out and cause some stress. But let's have a look at what could cause our property markets to crash. What's possible, what's realistic. And in my mind, it's not as simplistic as those bubblers think. It's not just interest rates. So to force people to have to sell their properties and give them away at prices that could be 15, 20% less than they were a year or so ago, it could be if they were unemployed. They just couldn't afford to keep their mortgages payments. But Stuart, that's not going to happen. We've got the lowest unemployment rate ever.
In fact, there's apart from inflation, every other economic reading is fantastic. Like commodity prices are doing well, balance of payments is in our favour. Our exchange rate is relatively low, so that's good for the economy. We've got low interest rates. We've got very low employment. We've got a higher participation rate. We've got relatively good GDP growth. Our debt is a lot higher than what it used to be for obvious reasons. So there are a couple of negatives in there, but when you look at it as a total picture, economically, it's really, really robust.
100%. So the thing that could and has in the past caused property values to crash is when you had high inflation, high interest rates and unemployment, when people couldn't keep up their mortgage. But that's not the case. Yes, will rates rise? Sure they will. By the way, I think maybe before people get too negative about what we're saying, we're not suggesting the property markets are not going to correct. They already are, but we're saying it's not going to crash. So we can talk about where we think they're going to head in a moment. But when rates rise, homeowners just tighten their belts and they keep up their mortgage repayments. Okay, the other thing that could cause the property market to crash is if interest rates went that high that a raft of homeowners would default on their mortgage. Now, we know just recently, a couple of years ago, the banks didn't want that. The banks gave mortgage holidays, the banks extended length of loans. They don't want to take over your home. But it doesn't seem that that's likely in the near future, Stuart, because anyone who's borrowed over the last couple of years has already been stress tested to see that they could manage loan repayments if interest rates rose 3%. And you know what? They probably are going to rise in that order of magnitude.
Yeah, I think so. To answer the question, what would cause a property crash in Australia? I would probably simplify it by saying a deep recession. A deep recession would cause property prices to fall significantly. And so then we've got to think about what would cause a deep recession. So it's not just one reading. It's not just interest rates. It's not just...
Not like the recession we had a year or so ago.
No, I mean, I'm talking like 90s, early 90s, something that's really...
that would cripple our economy.
That's right, yeah. So we've got to see a lot of things go south for that to send us into a deep recession. So in a deep recession, you're going to have higher unemployment. Higher interest rates might have caused a deep recession, so you might have higher interest rates at that particular period of time. The economy's shrinking, so people's incomes are lower as well. So all these things kind of need to happen at once to cause a deep recession. And in that situation, absolutely, I would expect that the price of property will fall. But then the question is, how close are we to a deep recession? I mean, we might get into a technical recession, for example, over the next few quarters. Maybe we might see GDP growth fall. We've seen consumer confidence is down, so consumer spending will be down. Interest rates and inflation is a lot higher. So we might see us, what technically a recession is 2 quarters of negative GDP growth. And we might see that, but it'd be very, very shallow, and it will be only a technical recession. And then once inflation sorts itself out, we'll be back off again. And even there's a lot of people out there in the market is also factoring in interest rate cuts in late next year as well, because obviously to re-stimulate growth. A deep recession is just not on the cards in Australia, and for that reason,
the other thing that has caused property values to drop but not crash is a credit squeeze. More than interest rates, it's really the flow of money, like happened when APRA tightened restrictions back in 2017-18 when there were too many investors in the market. But I can't see our regulators stepping in at the moment at the time of rising interest rates.
No, and credit's already pretty tight. I don't think credit will loosen. I don't think credit will tighten. I think they've found a relatively good balance. Through 17 and 19, we're talking about banks asking about, petty little expenses like Netflix accounts, and that doesn't happen anymore. They might have a look at, your past spending history, but not in the same level of detail that they were back then. So they are certainly over-tightened. I think they've found the right balance. But even during that credit tightening phase, Michael, Melbourne median prices dropped 2.2%, Sydney 3.1%. So there was certainly a correction because of less money flow going into the market, but it wasn't the 15-20% that are being thrown around at the moment.
Well, in fact, there has never been a property crash since regular figures were kept in from 1987 of the magnitude that the economists that we're talking about are suggesting. And when property values did drop, the biggest peak to trough drop occurred in 2017, 18, 19, when Sydney dropped 18.2%, Melbourne 14%, Brisbane 7%. But that was over a short period of time, but the overall Australian property market has never dropped to that sort of degree. And the circumstances were much worse than that. You've just gone through all the good reasons of what's supporting our economy and our property markets at the moment. Sure, a huge oversupply of properties could cause in certain segments property values to fall, like has happened when there's been an oversupply of buildings. But we actually aren't building enough apartments. We're not building enough new homes at the moment. In fact, we can't build them because there's not the supply. There's a difficulty with the trades. And only a week or two ago, I saw Australia's biggest property developer, Harry Triguboff, come out and say to make his new developments viable, financially viable, and he's not going to start building until it happens, the end value of units is going to have to increase by 20%. In other words, the next round of development is going to be much, much more expensive for all the reasons we understand, which is going to pull up the value of established properties. And until they can start building at those and selling at those levels, and no one's going to pay that at the moment, there's a huge undersupply of properties, Stuart.
That's right. And if we say we're at the start of, we won't call it, I mean, I'm almost loath to call it a correction, but let's call it a correction. Let's say if we start, or say
adjustment, that's a nice word.
Adjustment or new market cycle, whatever you want to use. The starting point is the most relevant. Are we starting at fair market value, or are we starting in a bubble? You know, are prices well above their intrinsic value, or are they at their intrinsic value? So when you have a look at the longer term growth rates that I was mentioning before, you'd have to draw a conclusion that most of the boom over the last couple of years has been mean reversion. Again, there's a little bit of FOMO premium in there, but most of it has been mean reversion. So it's not like we're starting at a point where property prices are ridiculously elevated. Now, of course, there's going to be properties that people can point to. This thing sold for $1 million too much or whatever. So there's always exceptions that prove the rule. But at a macro level, we're not starting at a point where property is ridiculously high. So then if there are any sort of corrections that need to feed through because of higher inflation or higher interest rates or any sort of changes in the economy, we're likely to see smaller reductions in value, say 5% or less, rather than major corrections. And the reason for that is because we're not starting at a point where property is wildly overvalued.
Now, interestingly, I get people trolling me on my YouTube channel in particular and on Property Update saying, but this particular economist, and I think we both know who we talk about, who I very highly respect, says in the Financial Review that property values are going to drop 30%. And I think we've got to remember that while everyone's out there giving their best estimates, these experts who are currently predicting the property market will crash are the same ones who made multiple incorrect doomsday predictions over the last couple of years. Remember the debt bomb, Stuart? It didn't explode. There was that fiscal cliff we were supposed to fall off when unemployment got high, when fixed interest rates changed to variable rates. There was one prediction after the other over the last 3 years, and going back even further. So experts just routinely get it wrong, and they keep changing their forecasts.
I've said before, property is part art, part science. Shares are all science, right? So if I want to analyse a share market, I can do it mostly analytically, and that's a good application. That's the right application to take towards that asset class. But because we've got own occupiers in the property market, it is part art, part science. The benefit that you and I have, Michael, is that we get to speak to and interact and talk to property buyers, property investors, home buyers. So we get to hear what they're thinking, their decision making, etc. Economists don't do that. They sit in their office and they crunch some numbers and they come up with some predictions and so forth. And so the economist that you're referring to, I think, is a super smart guy, very well respected. You know, I think he's a leader in his field, absolutely. But the problem that he's got is he's not speaking to property buyers every day of the week. So he doesn't really understand that it's not just the numbers that are driving these decisions, that just because interest rates have risen 2%, I'm not going to sell the home that I've fallen in love with. That because my kids go to school around the corner, and
you don't need to sell. That's the thing.
And I don't need to sell. That's right. Okay. My cash flow is a bit tighter, maybe, than it was, 2% ago, but I don't need to sell. Bang on. So,
and if you sell, you've got to move somewhere else.
Yeah, That's right. We all got to live somewhere. Yeah, and so I think that's the problem, is that if we put all the numbers in a spreadsheet and apply some financial theory and financial models, because that's what he's done. He's used the model that the RBA has put together, and that's fine. That's a good academic exercise. But the question is, does that theory apply in real life? And we all know you can't. If you want to go and select an investment property, for example, you can't take a purely analytical approach to doing that. I can't sit in my office in Melbourne and then analyse a whole bunch of numbers and find a property in Brisbane that I want to buy, because we all know that it's the art part that's missing. You need to walk through the property, see the property. It's got those different elements that other asset classes don't have.
We know there's a shortage of good properties. So while some properties are not selling at auction, others are languishing at private sale, A-grade homes, investment-grade properties are still selling because there are buyers out there. Yes, buyers are being more cautious. There's no FOMO anymore, so they're taking a considered approach, and there's now a flight to quality. But only recently, the new government has said they're going to have to increase the skilled migration intake, because all those people that they said were coming into the country haven't managed to get in. There seems to be some hold-ups with visas. What's going to happen, Stuart, when that bigger cohort of people are going to come from overseas? Where are they going to go? Where are they going to live? They're not bringing a home with them.
Well, clearly it's already a tight rental market, because a lot of those overseas, particularly if they're students, rent places, not only buy but rent mostly. It's going to create a very tight rental market, rental yields.
Not just the students, the skilled workers are the ones they're now trying to bring in with visas.
Yes, yeah. But also then the education part will return as well, Michael, which I think will create even greater demand for investors, because there'll be a big shortage of rental properties. And I can imagine next year we'll be talking about the rental crisis.
I think we're already there.
Yeah, and the government may be reacting to that, thinking about ways that they can encourage investors to build more properties and so forth. So it's all cyclical, but I think there's a lot of really good and positive tailwinds. The RBA is increasing interest rates, but there's a review of the RBA at the moment, so I think they're better off to do something rather than nothing for their own jobs, to preserve or try and preserve their own jobs. But it's not going to cool inflation. Inflation will just take a bit of time to run through, and I think maybe by the end of this next year we'll be talking about something completely different.
Sure, but at the moment it's the bogeyman that's scaring a lot of people, and that's the other factor that's in the short term going to affect the property markets, probably more than anything else: consumer confidence. It's fear and greed that drive our market, and while fear of missing out drove the markets in 2020 and 2021. Now it's the fear of buying early, fear of looking silly. You've spoken about this on this podcast before, the ego that drives people and not wanting to buy something and then look silly with your mates.
I wrote a blog last year, Michael. I think the headline was, "I wouldn't buy property in this market." I'm going to sit down today and write a blog. I don't know what the headline will be, but it'll be something like, "I'm very keen to buy property in this market." Which is to say that I think you should invest when your circumstances allow it, and you shouldn't try and guess where the market's going. So the headlines are a bit facetious, but I think the best time to buy property, I know the best time to buy property is when the conventional wisdom is it's the dumbest thing on earth to do. I think conceptually that makes a lot of sense to people. It is actually emotionally very difficult to execute on, because, when everyone's saying no, when everyone's crying poor, when everyone's saying it's the end of the world and prices will drop 20%, it feels very uncertain at that time to go and do the opposite and go and buy property. But the reality is, the only challenge at the moment, I think, is stock levels and finding something decent to buy. But the reality is, it's the best market to operate in, because it really is a buyer's market rather than a seller's market, which has been the case over the last couple of years.
Now, you mentioned about your blogs. I look forward to them every Wednesday, but I also look forward to your podcast where you actually talk through your blog. So I'd love to hear your take on it. So if you're interested in property, I'd be recommending you subscribe to Stuart's Investopoly podcast. wherever you're listening to this, his podcast is there as well. And you provide holistic advice. And that's why I like speaking with you. You help your clients at Pro Solution with more than just one element. So can we just have a quick chat about what you do and how you help your clients, Stuart?
We really work with clients on a long-term basis, Michael, to help them achieve their lifestyle goals. And I know that sounds like a bit of a sales spiel, but our view is that taking a holistic approach makes sure that clients make the most of all their opportunities and don't let any risks fall between the gaps. So we talk a lot about property on this podcast, and a property investment decision has a lot of elements to it. There's a tax element, borrowing capacity, loan structure, financial planning, cash flow, retirement strategy, how does he interact with super, all these sorts of considerations. And I think a sort of multifaceted team that can bring it all together into one plan is the best way to go. So that's what we love to do.
And you've been doing it for over 2 decades now. I remember when we first met, and you were a young guy then, but you've actually brought a lot of experience to your clients, which some of the younger generation of enthusiastic amateurs just can't bring. They've never experienced these sort of times before, but it's a multifaceted approach with finance, financial planning, and accounting. So Pro Solution Private Clients. And I'm going to leave a link in the show notes. But I think the bottom line of our chat today, and I love these regular chats, is there's no need to lose sleep. There's no need to worry about the value of your home or your investment properties in the long term. Will the Melbourne and Sydney market correct more by the end of this year? I agree with you, Stuart. I think we're probably going to get a 6% drop over Melbourne and Sydney over this year. And Brisbane will probably still be quite positive this year, even if it doesn't do anything else over the next 6 months. It's had so much growth that overall it'll probably have 10, 11% growth. Adelaide will probably be the top performer this year with maybe again over 10% growth. Perth will do well again. So when you balance it out nationally, we're going to have some areas falling, and even in Melbourne and Sydney, some areas are going to fall, others are going to hold their own, and others are going to go up a little bit. So on balance, our property markets will probably have a little fall over the year nationally, but not much, and next year a bit more. And then, as you say, life will go on. Greed and getting on with life will overtake the fear. So if you're not selling or refinancing, what's going to happen in the short term, in my mind, doesn't really matter. If the value of your property drops a little bit, it doesn't matter, especially if it's appreciated, as Stuart said, 25, 30% over the last couple of years. So again, I think we've got to make it clear, we're not suggesting property values always go up, far from it. And yes, we're in the correction phase of the cycle, but Stuart, I agree with you, no property crash in sight. Booms don't last forever, neither do downturns. So I guess my bottom line message is think long term. What would your bottom line message be? What would your final word like to be?
Listen to Michael Yardney, not the economists.
Oh, I like it. Well, you can listen to Michael Yardney and Stuart Wemyss once a month. Look forward to catching up with you again real soon.
Thanks, Michael.
I hope my chat with Stuart Wemyss gave you some comfort that we're not going to have a crash. But people are asking, how bad is the upcoming property downturn going to be? And with all the negative media, I can understand that people are getting worried. Now, I hope you understand from the chat I had a moment ago that I'm not worried. The answer is, without a doubt, the property markets are correcting, but they're not going to crash. And I know from experience certain markets are going to be back stronger than ever. Why am I so certain? Well, all you need to do is look back at history of financial markets. Since the early 1900s, we've been experiencing similar cycles. Markets overheat, fueled by inflamed demand, and then they inevitably flounder or falter. But in this particular cycle, the markets didn't really overheat. I've personally traded through it, 6-7 property cycles, and I've learned to recognise these patterns. So the correction has already started in selected markets, but there's still plenty of growth ahead in other property markets around Australia. Yeah, they're slowing down a bit. They've moved maybe from fifth gear to second or third gear, but not into reverse. However, if the last couple of years have taught investors anything, it's to expect the unexpected. And that's why I'd suggest you should prepare for the worst while hoping for the best. In other words, maximise your upside while at the same time covering your downside. And that's why I believe you should be having a chat with my team at Metropole, who provide holistic advice to clients. And some of the ways we're helping our clients prepare for the inevitable storms is by putting a strategic property investment plan together. As you've heard me say over and over again, property investment's a process. It's not an event. You don't go just out and buy a property. So the property you're going to buy will be the physical manifestation of a whole lot of decisions you've got to make beforehand and in the right order. Otherwise, you will be a casualty of the market. So you can't just run off and buy a property. You can't just run off and speak to a buyer's agent who has got properties for sale. I recently heard somebody call themselves a buyer's agent, but what they did was they were selling a complex of apartments on the Gold Coast. And you can't be a buyer's agent if every client needs exactly the same property and exactly the same development. You're not representing the buyer well, are you? So I believe you need to put a plan together and then follow the plan. If you want to understand more about the benefits of a strategic property plan, have a complimentary clarity consultation with my team at Metropole. Go to metropole.com.au and you can find out how we can help you. We've got a range of services: buyer's agency, property management, renovations, development, wealth advisory, financial planning, and even business coaching with Mark Reed and Business Accelerator Mastermind. So we'd love to be part of your wealth creation journey. This is the time not to speculate, not to take chances, but have yourself set to get your ducks in a row, because as the markets move on, and they will, some great opportunities will arise. And if you're financially ready, I think when you look back in 5 or 10 years' time, you're going to be impressed that you've taken advantage of those opportunities. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to explain to you that how you see the world has a significant effect on your success. I've learned that broadly there are two ways of seeing the world, and they have a great influence on how successful you become. The first is what psychologists call an external locus of control, and the second is the internal locus of control. You see, as the world around you changes, you can either attribute your success or failures to things you've got control over, or to forces outside your influence. And which orientation you choose, that's going to have a great bearing on your long-term success. Now, this concept dates back to the 1960s, when Julian Rotter's investigation of how people's behaviours and attitudes affected the outcomes of their lives brought about this concept. Locus of control describes what individuals perceive, what they think about the underlying causes of their events in their lives. Look, put more simply, are you the pilot of your life, or are you just a passenger going along for a ride? Do you believe your destiny is controlled by you or by external forces, such as fate or your boss or the government or the system or other things? Now, researchers have found that people with an internal locus of control, they tend to praise or blame themselves for the successes or failures. They don't assign responsibility to things outside their influence. A student with a strong internal locus of control, for instance, they're going to attribute their good marks to their hard work rather than to being naturally smart. A salesman with an internal locus of control is going to blame a lost sale on their lack of hustle rather than bad fortune. Internal locus of control can be linked to academic success, higher self-motivation, social maturity, lower incidence of stress and depression, and a longer life. Well, that's what psychologists said, and I agree with them. I found that people with an internal locus of control tend to earn more money, have more friends, stay married longer, and report greater professional success and satisfaction. What's an external locus of control then, if people with an internal locus of control do better? Well, we all know those people with an external locus of control. In fact, sometimes we are those people. Nothing is their fault. There's always an excuse. The world is out to get them. Life's unfair. Having an external locus of control, believing that your life's primarily influenced by events outside your control, that's been correlated to higher levels of stress. Often individuals perceive the situations just beyond them, beyond their coping, beyond their capabilities. Now, I guess what I'm trying to point out to you is the benefits of having an internal locus of control. As I said, in general, people with an internal locus of control, those who believe they're responsible for all their actions, they engage in activities that are going to improve their situation. They emphasise striving for achievement. They work hard to develop their knowledge, their skills and their abilities because they know when they do, life's going to be better. They're inquisitive. They try and find out why things turned out the way they did. They take note of information that they can use to create positive outcomes in the future. They've got more participative management styles. So the bottom line is, you weren't born with an unalterable locus of control. So it's critical for you to keep an eye on yourself and see how you can improve, see how you can get on further in this world. Sure, bad things happen to us, but rather than dwelling on them, it's better to find a useful belief about them and move on. It's important to remove the idea that your life is dictated by forces outside of you, outside of your control. Look, of course, to one degree or another, it is, but there's plenty that we can control. And you can create your own luck through study, through hard work, through perseverance. It's often said that you're a blend of the 5 people you hang around the most. This is important to keep in mind. Associate with positive people who believe they're in control of their own lives as well, because their beliefs, their energy is going to rub off on you. And then yours will rub off on them. It becomes a powerful and positive feedback loop. So, as I said, the way you see the world will have a huge significance on your success. It's important for you to realize you're the pilot of your life, not just a passenger going along for the ride. Thanks for spending the last 40 minutes or so with Stuart and me. And if you got some benefit from our chat today and you know somebody else who'd benefit, I'd really appreciate if you told them about the Michael Yardney podcast. There's a share button on every podcast app, but just tell them in the old-fashioned way, or why not leave a review wherever you're listening to this. And I've got a way of saying thank you for being a subscriber to my podcast. Go to podcastbonus.com.au and I've got a heap of reports and ebooks as my way of saying thank you. I'll be back again real soon, but you can follow me on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group, where every day I leave a snippet of information that you won't get elsewhere. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?